Solution. Question 1. So you're looking for considerations and concerns with regard to accepting. Guys, I've put the reference to the paragraph so that you can find it easily, but you don't need to include that, okay? So, concerns and considerations with the competence and capabilities. They only looked at the partner. They should have looked at the whole team. And they haven't considered the tight deadline. They have considered that budget allows for experts. In terms of the client's integrity, the reason for the prior year resignation or request for them to resign is a concern. The potential bribe to get the lockdown permit of the subsidiary, but they purchased the subsidiary after being aware of that. Okay, the scope limitation, and just noting there's a concern that the auditors didn't pick up a scope limitation. They actually said there was no scope limitation. In terms of the ethical requirements, only the partner was considered. The non-audit services, they did not consider the significance and the safeguards of the specific type of service that was being provided, and then not being able to contact the previous auditors. That could be a concern, and ultimately should potentially refuse unless there's exceptional circumstances. Other factors, concern whether they'll be able to pay the fee, and the fact that there were no engagement letters. Risks at the financial statement level, you guys should do really well in this type of question. So it's a new engagement, 2 risks always. Concerns with management integrity, all the concerns you noted above in pre-engagement that were from the background information can be included. But this question limited you to the background information, so you couldn't use anything that came from the questionnaire. Okay, non-compliance with IFRS because of those disagreements. They listed, so 2 risks of being listed. The significant growth and control environment potentially not being up to date or to scratch with it. Damage if they sell expired goods. Litigations that could arise from that. Non-compliance with food industry requirements. And owner managed, so big risk there. Related party transactions, because they do transact with a related party. And then all the going concern risks that came up, as well as the tight deadline. Guys, note here, I put notes to say you needed to use the information from the background information only. And there are no marks for the group because you were limited to the company alone. Risks at the assertion level for accounts receivable, so you get a mark for the assertion, you get a mark for the risk. They specifically said that in the question that you needed to link it, so that's why they're going to give you that mark. Concern with creditors or credit sales is the credit limits and how they're set. But then guys, I didn't pick it up in the reading time, and I didn't pick it up because I didn't go through the work again. But for existing customers, they don't go and check that their credit limit is still they're still within their credit limits after making the new sale. Okay, so that we only discussed it from the new way that they determine credit limits for new customers. It could be over or understated because of valuation if they use the incorrect price, if they don't use an updated price list. There's no real indication there in the scenario for that, but knowing your cycle, you know that there should be an internal sales price list. If they don't have that, they could use the incorrect one. They deliver the incorrect goods because there is that lack of segregation of duties between the picking and loading. Accounting policy because of management bias, so just because there is going to be an allowance that they will have to work out, which will be an estimate, so I can always bring that a risk at valuation. And then there's no reconciliation for debtors to the control account, so it could be wrong there. Risk that accounts receivable is not complete if Sue doesn't actually update the inventory model and just takes the meal from the warehouse and the delivery continues, but they don't now have the recording of the sale. Okay, so it's not the theft of inventory here, guys. it's the fact that if you don't update the inventory model, the revenue doesn't get recorded because the invoice and delivery notes are automatic from the inventory module. So if she doesn't put that through, then the invoice doesn't get created and revenue doesn't get recorded, so neither does the debtor for completeness. And there could be overstated, there could be fictitious orders because of the lack of segregation of duties and authorization for the audit department. Invoices are generated before the revenue takes place, so does the debtor actually exist at the time it's being recorded? And then no reconciliation between the revenue and signed delivery notes. So they could have recorded revenue that has not taken place. And then finally, guys, this was a very theoretical question. So look at this, 25 marks available. You needed to come up with any reasonable control for cash sales. Okay, and using just a normal takeaway restaurant or using a petrol station as an example, that should help you to pick up some of the controls. So the segregation of duties is really important. And then the cash takings being removed when they are ready for banking. Okay, all of the controls over the cash. So how they should go about counting the staff, 2 people, they sign what they've counted, they bank what has been counted. Till slips and the till roll need to go to head office because head office does the accounting. Okay, other controls here, supervision and review. That's why there's managers. They should be supervising and reviewing. We discussed access controls or security cameras as a specific control there. The signs, there was an additional sign here about the fact that there should be prices displayed so customers can see these are the actual prices, and the person who is at the till doesn't go and put through whatever price they want. They've got to use the prices that are required. Okay, your credit card controls, making sure that they are valid, so checking with the bank. Refunds must be authorized because that's cash out. Okay, and then the standard bank controls, having a bank reconciliation, really important as soon as you are dealing with anything cash or bank related. Okay, sales then get recorded based on what is in the actual till, because that's where revenue did take place. Okay, and then they can have other recons, monthly sales recons, because there are those reports that are generated. Okay, but loads of controls there. I just expected you to use your brain, a little bit of thinking for this question, because it isn't your typical revenue cycle controls. This is now only dealing with cash controls. Okay, so it's a little bit different from the whole revenue cycle from start to finish that we've already done. Alright guys, so after this, I expect that you've got a summary of learning points. I expect that you work through this. Make sure you're comfortable with all the mock tests. Go and attempt other questions if you've got time. And then all the best for test 1.